An absolutely massive week ahead for financial markets. Iran remains a key concern, and certainly things could go from bad to worse if we don't see a resolution in the near future. Alongside that, we've got a whole host of economic data, but most notably central bank releases, with the Federal Reserve rate decision heading things up. And we've got earnings across the board, but most notably, four of the Mag 7 names reporting in the week ahead, with the recent rally for big tech helping to drive the S&P 500 and the Nasdaq into record highs. So will we see more of the same for the week ahead? This and more, make sure to join us on today's video into the week ahead. So first and foremost, we can take a look at the economic calendar. Like I said, a huge amount going on this week, and it's really focused around two things: inflation and central banks. And you can see that here. So the BOJ rate decision on Tuesday, then we've got the Bank of Canada and the Federal Reserve on Wednesday, then we've got the ECB and the Bank of England on Thursday. So there's your central banks. And then inflation coming out of Japan on Tuesday, Germany on Wednesday alongside France, Eurozone on Thursday, and the core PCE price index out of the US also on Thursday. So predominantly it's 3 days where we see an absolutely huge amount of data coming out. Now, I'm not going to be able to cover all of this because there's a lot of other things for us to cover for the week ahead. So I'm going to pick one, and that, of course, has to really be the US. It's so central to global thinking. But notably, we know exactly what's going to be coming out of the US, and that is that we're going to see a rate pause once again. But what's notable is we also see the core PCE price index coming out later in the week. You can see markets are expecting it to come in at 0.3, so relatively under control, a little bit higher than they would like, but certainly not the same kind of thing that is expected for the headline PCE number, which is 0.6, with a rise to 3.3 on that figure. And that's where we start to see the differentials really starting to develop between core figures and headline numbers, because really much of this is just an energy story as things stand. But we have the rate decision coming up on Wednesday, and you can see, so that's inflation. You can see in terms of market expectations, they don't expect much because there's a huge amount of uncertainty ahead. Now, notably, if we do see Walsh coming into play for his first meeting in June, markets still think there's a 99.5% chance that we see a pause at that time around. And there's a good chance that he maybe isn't in the post at that point because, of course, there's the ongoing DOJ case against Jay Powell. And many are saying that they shouldn't replace Powell until that has been concluded. Notably, we did see an appearance from Kevin Walsh, two appearances, one at CNBC, but then a notable one in front of the Senate, where he got a bit of a grilling. Markets really took it that he was relatively hawkish when it came to his appearance before the Senate, and certainly alluding to the idea that he wants to essentially keep a lid on inflation. And it seemed like it was sort of a non-negotiable to be able to target inflation and get it back down towards target. That, of course, is problematic given the fact that right now inflation is soaring, particularly headline inflation. But as we can see here, in the CNBC interview in particular, you can see that he really leaned on the idea that AI is going to be massively deflationary in nature. And you can see here we're in the early innings of a structural decline in prices. That, for many, means that we can expect significant rate cuts from the Fed under Walsh. He says that they need a new structure, a new framework for the modern age, and relying on the old framework, despite the fact that we're in a brave new world, really, with AI, doesn't make sense. We're expecting to see less from the Federal Reserve because he doesn't necessarily want to be constantly providing comments to the markets. He doesn't want to constantly give you forecasts and dot plots and things like that, because it essentially provides the basis for incorrect market expectations. But notably, if we see less data and less comments, then markets really just have to sort of take a guess. And it's likely that when it comes around to rate decisions, more people will be wrong than is currently the case. And certainly there's an argument to say that if markets convince themselves that something's going to happen, despite the fact that maybe the Fed don't believe that, then the Fed might be pushed into making decisions based on what markets expect rather than what they believe per se, because they don't want to spark volatility. So it's notable it could be a two-way relationship. Now, in terms of inflation, like we can see here, headline inflation, a massive spike for March. This time around, we're waiting for the March core PCE price index figure. You can see that has been elevated over recent months, but we certainly haven't seen that spike. But you wouldn't do until we see March. So do we see March represent headline CPI, as you can see here, relatively under control, or do we see that surge in terms of price pressures? Probably not going to show up to the same degree for the core PCE price index, and you can see markets expecting 0.3. So certainly if you're looking at that inflation gauge and thinking that's going to give the big warning sign, maybe the headline PCE number does it, but the core PCE figure likely won't. So in terms of what we're looking out for, let's just jump onto the chart and take a look here at the US dollar index. Now, in terms of the wider picture, you can see essentially we see this long-term downtrend. Then we see over the course of this conflict, it kicked off here, the Iran conflict. We've sort of peaked out here and dropped low. Now, this really is going to replicate what's happening in terms of oil prices. So much of this is going to be a reflection of market sentiment around the Iran conflict. And with the fact that oil is starting to turn higher once again, you can see the dollar index doing a similar kind of thing. Now, we also saw gains over recent days around those comments from Kevin Walsh. So certainly we'll be keeping a close eye out for the Federal Reserve's interest rate decision, as they likely grill Jay Powell over the idea that AI is going to drive down prices and therefore lead to lower interest rates for the longer term. So the idea of how the rest of the bank are feeling around this, because of course it's not just Walsh that gets to vote once he's in the position. If he gets the position, he'll have to convince others within the committee. So certainly the views of others will be very notable when it comes to that position. So we can see here that the dollar index is coming off a little bit today. Now, notably, we have seen some comments saying that we could find out soon whether the Iranians are going to come back to the table for negotiations. And it's all a little bit tetchy at the moment. As of course, the meeting in Pakistan just didn't happen because the Iranians essentially walked away. So if we hear that they're going to have negotiations, that likely provides a short-term reprieve in terms of oil prices, and that will likely drive the dollar lower. But certainly if we do hear more in terms of the Fed, in terms of their sort of hawkishness or perceived dovishness in line with the latest Walsh comments, then you're likely to see some volatility here for the dollar. But yeah, much of it right now is really being driven by what's happening in terms of oil, and we can see that exactly here. So if you overlay the two, you can see that very close correlation. So yes, worth noting and worth watching, but the importance of the Fed right now is less so than the comments and the developments around what's happening in Iran. Next up, we're going to be taking a look at, I'm kind of doing this in a backwards order because I think that Iran is probably the most important ticket. So you got to stay tuned for that part. The next part we're going to be talking about is earnings. And earnings thus far have been relatively strong. And you can see in terms of the equity markets in the US, they've been strong as well. The S&P 500 hitting record highs, the NASDAQ hitting record highs. But by and large, that's not necessarily been driven by the entire market per se, and we'll get onto that. So here's the breakdown in terms of the earnings to watch out for. Visa, Coca-Cola, T-Mobile, Booking Holdings, General Motors on Tuesday, then Microsoft, Amazon, Alphabet, Meta, AbbVie, and Qualcomm on Wednesday. So a massive day on Wednesday. Apple, Eli Lilly, MasterCard, and Merck on Thursday and Friday, ExxonMobil and Chevron rounding things up with a focus on oil and gas. So you've got Microsoft, Amazon, Alphabet, Meta on Wednesday, and Apple on Thursday. So we've actually got 5 of the Mag 7 names reporting in the week ahead. I can't go through all of them here. But of course, there's going to be a big focus for all of these on the sort of CapEx side of things. Of course, the sort of hyperscaler story, are they spending too much? Are they getting enough money back for that money? So any signs that they're really starting to build significant revenues off the AI spending, that would be something worth following. And alongside that, you're going to have some of the core drivers of profitability that generally have been relatively, not necessarily old school, but just something that's kind of been the story prior to the AI boom. So for like Apple, you're going to be talking about iPhone sales. When it comes to Microsoft, which is what we'll talk about now, it's the cloud business and Azure. And notably, of course, you know, where we've got the strength recently, you can see here, it's not necessarily a case of all of the markets sort of booming. It really has been the information technology side of things and the telecom side of things. So generally, this is a tech story. and an energy story that has been lifting the S&P 500 recently, most notably the tech side of things. And so certainly when you're looking at the possibility of further gains coming into play, so are we going to see more record highs for the S&P 500? The fact that we've got 5 of the 7 names reporting means that we're likely to see major volatility for the market as a whole, because these huge weighted stocks are all going to provide us with updates that potentially scare people away and get them to sell off, or potentially get people to jump on board the ride. Now, here's a breakdown in terms of price action for those Mag 7 names of late, and you can see that by and large it's Tesla that's sort of lagging behind. We saw their earnings coming over the week just gone, the week I'm speaking within, and notably it was good. But then once markets heard about their capex, then we started to see it selling off, and that capex is likely to ramp up because they want to get into the semiconductor business. And that's something we were talking about last week, that was going to be potentially the key thing to be watching out for, because getting into semiconductors is not a cheap business. But this week you can see here that we've got the likes of Microsoft coming into the fold. And what's notable here is that we have, of course, got a story that has recently seen the company selling off. Now, Microsoft got caught up in the big sell-off where we saw the Anthropic-led decline in terms of software stocks, and people really started to question the valuations for Microsoft, which by and large has always been a software stock. And so is that justified? And certainly there's some people that will say that their Copilot AI solution is a little bit clunky, and that they've seen other companies like Anthropic providing services that arguably do a better job. So why would people pay for the Copilot product? Nonetheless, as you see here, in terms of the percentage of sales, we're on the cusp of seeing the Azure cloud services, or cloud services as a whole, headed up by Azure, overtaking the sort of traditional services and software side, with the Office and Outlook, Word, Excel, all of that. So you're seeing the cloud side actually overtake it before too long. So that's really the side of the business that grows the fastest, and soon enough will have the heaviest weighting. And so you're looking here in terms of sales growth much higher, in terms of the operating margin lower on the cloud side of things. So if we're looking at this report, we need to see the Azure side of things remain strong in terms of growth in the cloud business. But there will be a focus in terms of the AI side of things, of course, because they have been one of the key leaders in terms of spending on the AI front. And so question marks will be sort of emerging around the Copilot product, and whether they're seeing a significant uptick on people paying for that product, that remains to be seen. But certainly that's going to be a key element to focus on. If we look in terms of earnings per share, we can see a couple of things. Firstly, we've got the annual figure at the bottom. So of course, we're expecting that it's going to gradually rise over the coming years. So essentially, we have a sort of long-term pathway, but that to an extent should hopefully justify the elevated valuations that are in play at the moment for Microsoft. Notably, if we look in terms of, I seem to have chopped it out here for some reason, makes no sense. But anyway, pretty much so every single quarter and the top section that I have in this chart had beat expectations. So it'd been a positive surprise. So in terms of earnings per share for Microsoft, if we look at the past couple of years, they've beat pretty much every single quarter in the last couple of years. So that provides the basis for us to be quite bullish for expectations around those earnings. Of course, markets generally, especially after a strong run-up, can be a little bit unforgiving when it comes to looking at earnings. You could beat on the top line, beat on the bottom line, and ultimately just give a bit of a sort of weak number somewhere else, and people probably jump on that and start to sell the stock. So certainly one to watch out for. But the Azure side of things and the Copilot side of things really will gain attention alongside the capex spending. Let's just jump onto the chart then and see how things are shaping up in terms of the Microsoft share price. So let's go. Here we go. So we've got this weekly time frame, and what's really notable is the size of that sell-off. Now, we can see from the peak that we had here in October of last year down to the low, you're talking about essentially a third of the stock wiped out. Now, what have we seen recently? Well, we've seen a rally up through resistance that signals the possibility that that sell-off is over. So are we back into a bullish phase? Potentially, but I would be somewhat hesitant. We're losing a little bit of traction, certainly if because of the fact that we've seen a strong run up. I wouldn't be surprised to see us move back into this area before the bulls come back into play if this is a bottom for the stock. We've rallied up into a higher high. We've got to set that higher low as well. Of course, there's a possibility we continue to move and the higher low is here, but you don't necessarily know exactly how it's going to play out. But if we see the stochastics breaking back through that 80 threshold and we break back through the 414 support level, it potentially paves the way for that pullback to come into play. But certainly as things stand, the size of that pullback doesn't really seem justified. And if you see this earnings report, they hopefully will provide you with enough reasoning to believe exactly the same in terms of the idea that that sell-off was not justified and that they're going to continue to head up the AI boom with the Mag 7 names. So keep an eye out for this. They have history when it comes to beating market expectations, and therefore more of the same looks likely this time around. And let's wrap things up by talking about Iran. This is really the thing that continues to dominate markets right now. Now, we've got mixed messages from Donald Trump. Essentially, he's talking about clearing the straits. So that makes you think that we're going to see the Straits of Hormuz open again sometime soon. But he's also talking about killing boats and shooting boats. And, you know, it's a bit all over the place at the moment. And at the same time, you, of course, saw the meeting that was supposed to take place in Pakistan. He said coming into it, I'm not going to extend the deadline. And I noted to you guys on a video a day before saying, you know, he's going to extend the deadline. They don't have time to come to an agreement that's going to be an all-encompassing agreement. So they'll probably extend the deadline, not knowing that they would actually not even have the meeting. And they still extended the deadline. So the idea that he didn't want to do it and then he ended up doing it even without a meeting and that the Iranians didn't turn up says a lot, quite frankly. So right now we're in a little bit of a limbo, and that's exactly what everyone is growing fearful around, because essentially this is a game of chicken. You've got the two sides waiting for the other one to basically turn up and say, okay, fine, we've gone through enough pain, we'll give you what you want. But there's a good chance that neither do for an extended period of time, and that is painful for markets. So you can see here the US and Iran delay talks and high stakes game of chicken. For the US side of things, they think that the blockade is putting pressure on the Iranians. They think the longer that this blockade goes on for, the more damaging it will be for revenues coming from oil and gas, and potentially cause major long-lasting damage to the oil and gas facilities within Iran as they become backed up when inventories essentially max out, and the shut-ins associated with that could take a long time to recover from. So that's what the US believe will be the reason why the Iranians will ultimately give in to their demands. The Iranians, for their part, know that the higher the oil prices go, the higher inflation expectations go, the lower that we see equity markets, the more Donald Trump will be concerned about his ratings back at home in the midterms election. Midterm. He's not necessarily on the cards, but certainly the Republicans are, and he could lose the House or the Senate, which means that he loses the ability to enact everything he wants. Maybe he tries to front load more of it and get everything done ahead of that. But nonetheless, he wants to get out. It's very clear. And the Iranians will believe, probably rightly so, the longer this goes on for, the higher energy prices go, the more pressure there is on Trump to essentially just give in. And so when you've got both sides that seem to be emboldened, it raises concerns about an extended period where we see the Straits of Hormuz closed even further. And bear in mind, if they're shutting it off on to even Iranian ships, that's even more oil that would have been going to the market somewhere in the world that now isn't. So those shortages are really going to be biting soon. Bear in mind that many of the ships that set sail around the time that the war started in the beginning of last month will have only got to their destinations relatively recently. So this is when we're now starting to see the drawdown in terms of inventories. And when those inventories run dry, or when these countries don't necessarily want them to run dry, and so they don't release as much to the market and they rely on market forces, so you could see a sharp uptick in terms of energy prices. Now, some countries are more shielded than others when it comes to inventories. You can see the Chinese have been stockpiling like mad over recent years, and we wondered why. We just thought, well, prices are low, so they think that it just makes sense. But now you can see that it's definitely made sense, to say the least. Of course, the US has significant stockpiles, but they've also got the biggest oil and gas industry in the world on their doorstep. So they are relatively shielded, but maybe less so to global oil prices. Then you've got the Japanese, and the Japanese have been releasing some of their strategic reserves recently, and that to some extent means that they should be a different case compared to some of the other nations in Asia. Europe will have some, but of course that's spread across a number of different nations, Saudis, South Koreas, and then the Iranians. And certainly as time goes on, the stockpiles in Iran will essentially become maxed out, and that's where you see the pressure really being put on the Iranians. Now, alongside talking about what's happening in terms of oil, in terms of global oil prices, it's notable that the Russians have blocked this Druzhba oil pipeline to Germany. Essentially, it's Kazakhstani oil that should be going to Germany, but apparently they're not going to do so anymore. This puts further pressure on Germany because areas like Berlin have been very reliant on this oil after they essentially stopped taking Russian oil. And so it's problematic. It really is. Now you're seeing, because of the recent Hungarian election result, you're seeing that southern Druzhba pipeline that you can see on this map reopened, with the Ukrainians previously saying it had taken damage and therefore they couldn't let oil flow. But now, of course, we're seeing a change in Hungary, and you're seeing them say, oh, miraculously, we can actually allow oil to pass through here. So that makes a difference in terms of oil, but the oil is going to a different area. So it's not necessarily going to Germany as much, it's more going into Hungary and Belarus and the like. And so you're looking here in terms of the idea being that Germany could suffer as a result. And notably, we've seen weakness in terms of the German PMI numbers in the week just gone. And the Germans will continue to suffer if they see greater shortages compared to others. You can see here German imports have been increasingly reliant on Kazakhstan after we saw them really driving down imports from Russia and then driving down imports from the Middle East. Well, one by one, these countries are essentially seeing their supplies shut off to the Germans. So really, we're seeing a squeeze on Germany. That's why I wanted to raise the chart for the likes of the DAX alongside oil prices. Finally, here we've got the difference between what the Europeans and the Asians are paying for gas and the US. And so this does highlight the fact that, yes, gasoline and the price at the pump in the US is on the rise during this crisis, and that puts pressure on Trump. But it's certainly not under the same kind of pressure as some of the Europeans and some of the Asians, because energy prices have been significantly higher when it comes to gas elsewhere in the world, with the fact that the US has a huge amount of oil and gas on its doorstep, meaning that prices have just remained relatively low or very low compared to European and Asian gas prices. So the pressure on global growth is not necessarily on the US, and that is problematic because it puts less pressure on the person that needs to have the pressure on him to find a resolution. So this could mean that the conflict goes on for longer than others would like it to do so. So we'll wrap it up by looking at oil first and foremost, and we can see, bear in mind that we have, let's just jump onto this, bear in mind that we have, of course, now this game of chicken, so to speak, where either side's just waiting for the other one to essentially break. And we don't necessarily know that one will anytime soon. And so that provides us with the basis of the idea that oil prices could rise once again. Now, bear in mind that, of course, inventories are being drawn down, but at some point, those releases will have to stop or slow. And as time goes on, it's going to be more problematic because all of those ships will largely have arrived now. And so the shortages will start to compound now. And then it's going to take a good month or two, even once we see a resolution, for tankers to be able to get loaded up, get where they need to go, and for things to start to get back to some semblance of normality. So I think elevated oil prices are here to stay for a period of time, but certainly for the time being, with each day that passes, I think unless we see a significant move towards negotiations, towards a potential agreement, we're likely to further upside coming into the fore. And you can see here that sharp rally. Then we've seen this sort of falling wedge formation. Now the rally that we've seen up through your first swing high of 95.7 essentially is now being sort of built upon, where we see this gradual move towards the upside. I expect more of the same. Of course, the caveat here, as we say every weekend, is Weekends often bring huge surprises, and quite frankly, every day of the week brings huge surprises because we don't necessarily know from one day to the next what the news headlines are going to be. And half the time, even when we see a headline that moves the markets, you might see another headline an hour later, which completely goes against that initial one. So it's a difficult trading environment right now, quite frankly. But certainly as time goes on, unless you see those boats coming out of the Straits of Hormuz in a meaningful manner and we see a deal agreed, you have to be careful and cautious about the idea that things are over, because oil, I think, has a natural course right now, and that is upwards without any agreement being reached. And certainly the idea that we're seeing the shortages really starting to build from here on in does highlight exactly that. Certainly for Europe, the jet fuel problem means that we're going to start hearing more and more stories about flights being cancelled. And of course, that has a downward influence on growth within the region. And finally, let's look in terms of the DAX. And you can see here that the DAX has started to come off. Of course, we've been seeing a little bit of a mixed trajectory where at the beginning of the crisis, it sold off heavily, then it regained a lot of ground, and you can see it starting to come off once again here. Notably, if you look at the trajectory in terms of price action for the S&P 500, over recent times, you can see that it's the European markets that really have suffered. So this is the S&P 500 against the DAX and the FTSE 100. So underperformance here for the DAX and the FTSE. So European markets certainly suffering to a greater degree than US markets at the moment. And that's likely to continue to be the case because the US is shielded to a greater degree by the fact that they have domestic supply. So shortages will be less of a problem. And the US has this huge waiting for big tech that by and large is doing its own thing at the moment, and people are buying into that. As long as the big tech earnings over the coming week continue to remain strong and continue that narrative, US markets are likely to outperform the European markets, particularly if we don't see a resolution to the crisis in Iran. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.